30 minutes. That's what the time it takes to watch a sitcom. Eat a sandwich at your desk.
It's basically a throwaway amount of time.
Right. But on January 29th, 2026, that little 30-minute window, it changed the financial world forever.
Because in that tiny slice of time, $5.9 trillion of market value didn't just go down.
No, it evaporated.
It was the financial equivalent of oxygen just being sucked out of a room. No warning, no, gradual slide.
Just a vertical drop.
Yeah.
In the gold and silver markets. Yeah. Enough to wipe out the entire combined GDP of the UK and France.
In minutes.
And what's so unsettling about this isn't just the crash itself. It's that when the dust settled, we found that specific number 5.9 trillion sort of etched into the wreckage.
And not just in the wreckage, that's the detail that really keeps you up at night. When we started pulling on this thread, we found 5.9 trillion everywhere.
Everywhere.
In China's economic planning, in the debt locking up commercial real estate in the United States. We even found it sitting in the bank accounts of the super rich.
It's like finding the same fingerprint at 4 different crime scenes across the globe. So today, this isn't just about a bad day in the market.
Not at all.
We're talking about a signal. We're going to dive deep and figure out why the global economy seems to be recalibrating around this exact number, and whether we're looking at a catastrophe or a necessary mechanical reset of the whole system.
This is the end of the easy money era, and really the beginning of the era of consequence.
Okay, so let's go back to the scene of the accident, January 29th. Gold is supposed to be the safe haven, right? It's a boring asset. It's what you buy when you're scared of everything else.
That's the traditional logic, yes, but the market structure itself has fundamentally changed. We have to stop thinking of markets as a place where humans are shouting at each other on a trading floor.
It's a machine now.
It's a machine. It's dominated by high-frequency trading algorithms, HFTs.
And these aren't your typical retirement investors. These are computer programs just trying to scalp pennies millions of times a second all over the world.
Exactly. And the thing about algorithms is they don't have courage. They don't have conviction. They just have risk parameters.
Right.
On that Thursday, the data suggests a huge institutional player, probably a fund that was way over-leveraged in other areas, got a margin call. They needed cash, and they needed it immediately.
So they didn't sell gold because they suddenly hated gold. They sold it because it was the only thing they could sell fast to cover their debts.
Precisely. It's the classic smash the piggy bank effect. But here's where the mechanics get, frankly, terrifying.
Okay.
This fund dumps a massive amount of gold onto the market. Now, in the old days, human buyers would see the price drop and think, oh, a bargain, I'll buy.
But humans aren't the ones on the other side of that trade anymore.
Correct. The buyers were other algorithms. And these buying algorithms are programmed to do one thing above all else: detect volatility.
And a huge sell order like that would send volatility
Through the roof, off the charts. So the buying algorithms didn't see a bargain, they saw a threat, their risk protocols triggered, and they did something chilling.
They pulled their bids.
They just turned off. They stepped away completely. It created what traders call an air pocket, a liquidity void.
An air pocket.
Imagine you're leaning against a wall and suddenly the wall just isn't there. You fall. The price of gold fell into a void because for 30 minutes, there were literally zero buyers.
That's what feels so different from 2008 or even 1929. This wasn't an emotional panic.
No, panic is human. This was mechanical. It was purely structural. And that $5.9 trillion loss, that wasn't money just moving from one person's pocket to another's. It was value vanishing because the plumbing of the market failed.
So you've got this $5.9 trillion hole in the West created by a machine malfunction. But then you look east. You look at China.
And it's a fascinating reflection, isn't it?
It's almost a perfect mirror image. The documents coming out of their fiscal planning for 2026 show a number that is, well, it's uncanny.
It is. The People's Bank of China has set a narrow fiscal deficit target, which is basically the new money they're injecting into their system, at exactly 5.9 trillion yuan.
Now, I know what people are thinking. Oh, here we go again. China's just printing money like in 2008 to save the economy. But when you look at where this money is actually going, this doesn't feel like a bailout.
It's absolutely not a bailout. In fact, it's the opposite. In 2008, China poured stimulus into, well, bridges to nowhere, concrete, inflating the real estate bubble.
Anything to keep the GDP numbers high.
Right, at any cost. This time, they're engaging in what analysts are calling a controlled demolition.
Controlled demolition.
That's
That's a heavy phrase for economic policy.
But it's accurate. They are deliberately letting their old growth engine, the whole property speculation market, wither and die. They're letting developers fail. They're letting values drop.
Which must be incredibly painful for the average Chinese citizen. Right? Their wealth is all tied up in real estate.
It is agonizing. But the state has made a calculation. They're willing to accept that pain to pivot. They're taking that 5.9 trillion yuan and funneling it exclusively into what they call new productive forces.
So high-end manufacturing, green energy, biotech.
Exactly. They are taking the capital that used to build empty apartment blocks and forcing it into building microchips and solar panels. They're even using specific monetary tools, like lowering relending rates to 1.75%, but only for these high-tech sectors.
So if you want to build a mall, money is expensive. If you want to build a battery factory,
money is cheap. It's a pruning strategy. You have to cut off the dead branches so the tree can survive.
and that's the contrast. The West has this chaotic, accidental $5.9 trillion crash because its algorithms are too fragile. China is executing a strategic, painful $5.9 trillion injection to pivot its entire economy.
2 worlds, 2 strategies, 1 number.
Which brings us to the third piece of this puzzle. And we need to be very clear here for everyone listening. This is a problem happening specifically inside the United States.
Yes, this is the Western rot, as some are calling it. While China is purposefully demolishing its real estate bubble, the U.S. is sort of trying to pretend theirs doesn't exist.
And the number looming over American office towers and shopping malls is?
Approximately $5.9 trillion in debt.
It's everywhere. It feels like a mathematical constant in this story.
It's the limit. It's the wall the easy money era ran into.
Yeah.
And the situation in the U.S. is, frankly, dire. You have these huge office towers in places like San Francisco, New York, Chicago, all financed a decade ago when interest rates were basically zero.
The free money era.
Exactly. Developers borrowed billions, assuming 2 things would last forever: that rates would stay low and that people would always need to work in offices.
And both of those assumptions are dead now.
Completely.
Yeah.
Remote work is permanent for many, and rates are much higher. So now you have these buildings that are half empty, bringing in half the rent, but the debt on them is still $5.9 trillion.
So the building itself is worth less than the loan on it.
In many, many cases, yes. And this has created what's being called a zombie market in the U.S. Transaction volumes have collapsed by almost 60% because nobody can agree on a price. Sellers can't sell at the true lower market value because they'd instantly go bankrupt. But buyers won't pay the old inflated prices because they aren't stupid, so the market just freezes.
The old extend and pretend strategy. The American banks are just renewing the loans and praying for a miracle.
They are. But here's the systemic risk, the real danger for the U.S. economy. Who holds all this toxic debt? It's not just the big Wall Street banks.
It's the regional banks.
It's the small and medium-sized banks across America. They hold about 63% of this debt. These are the banks that fund small businesses, car loans, mortgages in the heartland.
That's a huge exposure. If that $5.9 trillion bubble finally pops, it doesn't just take down a few skyscrapers in New York. It takes down the whole banking infrastructure for middle America.
That's the bomb. So you have a flash crash showing the system's fragility. You have China aggressively pivoting away from this exact problem. And you have the U.S. paralyzed by a $5.9 trillion debt bomb that it's too scared to even touch.
But this is where it gets really weird.
Yeah.
Because, like in physics, right? Energy is preserved. If value vanishes from gold or it's collapsing in real estate, that wealth doesn't just disappear from the planet. It has to go somewhere.
It transfers. And this brings us to the final and I think the most telling appearance of our number.
The war chest.
Yes. We looked at data on the Liquidity holdings cash, basically of the top tier of global wealth, the ultra high net worth individuals, family offices, the smart money.
And they're holding a record amount of cash right now.
They are. And the amount they're holding in liquid cash and cash equivalents is sitting right at
Don't tell me, $5.9 trillion.
$5.9 trillion.
Okay, that is not a coincidence. That is a strategy.
It's the ultimate hedge. Think about it. The average person is being told to buy the dip. They're struggling with inflation and debt. But the people who really understand how the system works, they've cashed out. They're on the sidelines in cash.
But why? I mean, conventional wisdom says cash is trash when inflation is high. you're just losing purchasing power.
That's true if you think we're in a normal market, but they aren't playing for a normal market. They're playing for the reset. They are looking at that frozen U.S. real estate market, and they know those zombies have to die eventually. The banks will be forced to sell.
And when that happens,
Right.
when those office towers in Manhattan are being auctioned off for pennies on the dollar,
You're going to need cash to buy them. Credit will be frozen solid. The only thing that will matter is liquidity. That $5.9 trillion hoard isn't just a safety net. It's the purchase price for the next generation of assets. They are waiting for the bottom to fall out so they can buy the world at a discount.
it makes me think that UBS report we saw, the one about the shift from creators to heirs.
It fits perfectly. The last 20 years were driven by entrepreneurs, risk takers. Now we are seeing this massive transfer of wealth to the next generation, to heirs. And heirs think differently. They're wealth preservers.
They don't want to build a risky startup. They want to own the infrastructure.
Tangible assets, industrial production, financial services, things that are real. They're moving out of the buy stuff on Amazon consumer economy and into the industrial economy, positioning for a world of scarcity and hard assets.
So when we step back and look at this whole picture, the crash, China's pivot, the US debt bomb, this wealth hoard, you keep using the word reset instead of crash. Why is that distinction so important?
Because a crash implies an accident, a mistake, something that we can just fix and then go back to how things were.
But we can't go back.
A reset is structural. It's the system purging the excesses of the last 15 years. That easy money era from roughly 2010 to 2025, where you could buy almost anything and it would go up, that's over. It's gone.
And the $5.9 trillion figure is what? The price of admission.
It's the cost of admission to the new reality. It's the amount of bad leverage and bad ideas that have to be flushed out of the system before we can start again on solid ground.
This is a pretty sobering realization, especially for everyone listening who's just trying to navigate a career, their savings.
Yeah.
If the big machines are resetting, what does the individual do? We can't just say, good luck.
No, absolutely not. Knowledge is only useful if it leads to action. I think there are 3 very clear takeaways from all this.
Okay, let's break them down. Number 1.
Number 1, respect the machine. You have to understand, the markets are not human anymore. We saw it with gold. Prices can gap down instantly.
So don't try to outsmart the algorithm.
And don't rely on things like stop losses to save you. If liquidity vanishes, there's no one to sell to at any price. The volatility isn't a bug in the new system, it's a feature.
Okay, so respect machine. Number 2.
Liquidity is king. It's that simple. Look at what the smartest people are doing. They are holding cash. They are reducing their debt.
Which goes against everything we were taught for the last decade.
The game has changed. In a reset, the person with the most options wins. Cash gives you options. Debt takes them away. The priority right now isn't getting rich. It's survival.
And the third point.
Seek real value. We talked about the shift from consumer to industrial. Stop looking for story stocks, companies that lose money but have a great pitch. Those are the zombies of this new era.
Look for the boring stuff.
Boring is beautiful right now. Look for companies with actual cash flow. Companies that make physical things, that provide essential services. In this new era, reality gets rewarded and hype gets punished.
I'd add a fourth, based on our China and US discussion, diversification.
Absolutely essential. The world is splitting. You have the US dollar system and you have this new bloc forming around China. You can no longer assume that the American financial system is the only safe place for your capital.
It's about not having all your eggs in one basket.
Yeah.
Especially when that basket is sitting on a $5.9 trillion debt bomb.
Precisely.
You know, when we started this deep dive, that number 5.9 trillion, it felt like a ghost story, just a spooky coincidence. But now, it feels like a map.
It is a map. It shows us exactly where the pressure points are. It shows us that the global economy has hit a wall, and it's in the process of breaking through to whatever comes next.
So here's the thought I want to leave everyone with. We all have this tendency to wait for things to go back to normal. We want 2021 asset prices with 2019 stability. We're just waiting for the old world to magically come back.
But that old world was built on a foundation of cheap debt that doesn't exist anymore.
Exactly. So the real question is, are you going to keep waiting for a ghost to come back and save you? Or are you going to look at the data, look at this $5.9 trillion signal, and start preparing for the new reality that is being built right now in front of us?
The reset is happening whether you choose to participate or not. The choice is yours.
Thank you for diving deep with us. Stay curious, stay informed, and we'll see you on the other side.
Take care.